Hello everyone, my name is Manolis Finorilakis, the founder of Reality Crowd TV, and welcome to a very special episode brought to you by Vicken, the virtual incubator and crowdfunding network. In tonight's episode, on the eve of a historic vote by the Securities and Exchange Commission, we have with us a great guest who will tell us what he believes will happen if the Securities and Exchange Commission passes the proposed rules on equity crowdfunding, specifically Title IV equity crowdfunding of the Jobs Act. And so I'd like to introduce my guest tonight. We have Sam Guzik, a corporate securities attorney, crowdfunding expert with Guzik Associates. And Sam, pleasure to have you, and please introduce yourself to the audience.
Yes. Thank you, Manolis. Thank you for having me on, and thank you for all your really great work that you're doing to get the word out and educate people. I am a corporate securities attorney in private practice. I've been doing it for over 35 years. You can look at my bio on LinkedIn, but I've been in big firms, medium firms. I've had my own firm, now a boutique firm based in Los Angeles since 21 years or so. My practice has been primarily focused on representing smaller companies on the issuer side. When I say smaller companies, I mean small companies that want to go public, small companies that do go public, mini cap, micro, nano cap, up to $250 million in market capitalization. So that's my sweet spot, and what I like to enjoy most is helping companies grow and in most cases doing something that nobody's ever done before in business. So that's basically who I am in a nutshell.
Sam, thank you so much, and you're a humble guy. I mean, you're one of the thought leaders in this industry, specifically on Title IV as well as the other provisions. But you know, the topic of today's discussion is going to be Title IV, known as Regulation A, and we're not gonna be talking in these type of terms the whole time. Because those terms don't mean much to our audience. So the best way to ultimately give everyone a primer on equity crowdfunding is to actually show you this video from the White House that was actually produced right after the Jobs Act, which is paving the way for equity crowdfunding. It was produced right after that historic signing of that law, and so I will share that YouTube video now for everyone's viewing pleasure.
Crowdfunding is a concept that's been around for a long time. It's the idea of passing around the basket at church in its oldest incarnation, of a large crowd of people being able to contribute small amounts, which in aggregate meet the financial goal of any organization, group, or individual. And so when you look at crowdfunding and how it's evolved, the reason it's become a buzzword recently is because it's gone online, and so the potential of it has expanded exponentially. The crowdfunding bill is important for small businesses because it creates access to capital. Access to capital that currently is very hard to come by. The basic concept of this will mean for entrepreneurs and investors is that an entrepreneur will post a description, a very thorough description of their business, the finances, the business plan, what they're going to do with the money, the budget, etc. And they're going to be able to share this opportunity with anyone they so choose. Most likely it will be their customers, friends and family, might be Twitter followers, people who share an affiliation with them if they think they'd be interested, etc. The investor will then pledge a certain amount of capital if they want to invest. If the fundraising goal is met for how much money that entrepreneur is looking for, then the money will transfer to the entrepreneur. So it's an all or nothing arrangement. What I hope that America will now see is that after the SEC rulemaking period is done on the crowdfunding bill, approximately 9 months from now, some platforms can be created and launched that allow for crowdfunding, that entrepreneurs who currently feel like funding is a roadblock to them achieving their success can now have the opportunity to succeed. I strongly believe that crowdfunding is not just for high-tech businesses. I in fact think that the majority of people are going to be using this in the long run. The majority of businesses in the country are small businesses, and that's who can really take advantage of this.
So as you can see, she really gives a nice overview of the whole process, the equity and debt-based side of the industry. And so, Sam, give us a little history of this law, because I think it's I think the history is important for people to know. You know, how did this Jobs Act come about, and how long has it been now since these rules have been proposed, and hopefully by tomorrow one of the largest ones will be finalized.
Okay, so let's start where it all began, at least in modern history, which was the Jobs Act, 2012, and it was broken down into four titles. Everyone knows Title III, that's crowdfunding. Title II is general solicitation, but you can only be an accredited investor to invest. And then we've got Title IV, which is has been somewhat of a sleeper, which has become commonly popularly referred to as Regulation A+. Some people, including myself, have referred to it as a mini IPO. Yesterday there was an article in Forbes that referred to it as IPO light. So let me just take you back a little bit in history to see where this came out of, because Title IV didn't come out of a vacuum. We had this basically very little used exemption back in as far back as 1936, which was intended to allow companies to go public, but on a very small scale with very little expense. Basically, an expedited filing and review process with the SEC. And once they went public, they didn't have to file any public reports, unlike public reporting companies. So that seemed like a good thing. And by the time the 1980s rolled around, you could raise up to $5 million in 12 months. Well, it sounds good, except almost nobody used it. And there's two reasons why nobody used it. One was you could only raise $5 million. I'm not going to suggest that $5 million is not a lot of money, but for this level of capital raising, it's not a lot of money when you want to get broker-dealers involved and help you sell the deal. Secondly, and the biggest problem with it, in my opinion, was you would file with the SEC, go through an SEC review process, and then you had to go through a similar reviews process in every state that you wanted to sell your securities. And what that meant effectively in some states was you were never going to get to sell your securities if you were deemed too risky by state standards. And you know, the classic story is the Apple IPO in 1980, when the state of Massachusetts and about 17 other states said, you know, this is too risky, this is a hot IPO, and the rest is history. So basically, Reg A was not very much used. I refer to it as a one-hit wonder, because the only time it really got any notoriety was back in the 80s when Ben & Jerry's went public, and they used Regulation A and they raised a few $1 million, but other than that, it's been kind of worthless. So when it came time to doing the Jobs Act and revamping our securities laws, Congress kind of figured this out, and they said we need two fixes here. One is we need to raise the dollar ceiling from $5 million. They did that. They bumped it up to $50 million, and they actually gave the authority to the SEC to raise that even higher after 2 years. And time flies, we're already past the 2 years. The second thing they did, which was critical, was they put in a provision there which basically took away from the states the authority to review these offerings at the state level under one of two conditions. Either the company was trading on a national exchange, or the investors in the offering were all what was referred to as qualified purchasers. So then the question is, what are qualified purchasers? That was left to rulemaking, and we had proposed rules that came out in December of 2013, and the SEC surprised everyone, including myself, and they said basically everyone is a qualified purchaser. With a caveat, which is everyone is limited to how much they can invest, whether they're accredited or unaccredited, to the greater of 10% of their income or net worth, exclusive of their principal residence. So what this really became, in a way, was a type of crowdfunding statute, because now you're opening up capital raising to both accredited and unaccredited investors without doing a full-scale IPO. So that's kind of the history. And proposed rules are out in 2013, and the SEC told us last Friday that tomorrow they're going to vote on final rules. So this is somewhat of an opportune moment to have this little discussion.
Absolutely, Sam, and again, thank you for joining us, because like I feel very blessed to have you on the eve of this historic announcement. I want to actually summarize a little bit of what you said, because there was so much that was said that I want to make sure that my audience is up to speed. So, Regulation A, which is an old form of capital raising in America, has been around since 1936. it wasn't successful for two reasons. Number one, companies couldn't raise over $5 million using it. And number two, even though that old provision allowed for individuals who were unaccredited, meaning anyone regardless of income was able to participate in this old way of raising money, the problem was that it got so expensive to actually do those raises because each state where that individual was that they were investing in the company from had to approve a separate package and a separate securities offering. So the old rules were basically dead in the water. Then, because of the Jobs Act, because the American public was using the Kickstarter method and Indiegogo, and there was a lot of traction with that globally, the government in 2012 said, my God, if it works for donation in exchange for a reward, could it work for equity in exchange for a piece of the company, a contribution in exchange for equity or debt? And the hypothetical reward or the reward would then become a return on your investment. So when the government passed the law in 2012, what Sam just told us is that they revisited the old Regulation A, and they made the two key changes that he just mentioned. They said, let's increase the limit to 50 million, and let's also eliminate the bottleneck within the states, and let's have it be a federal exemption, which allows for it to be done nationally instead of state-by-state approval. Is that ultimately the gist of what I just heard? Is that right, Sam?
Yeah, that's a gist, and then there's some, important details to just kind of flesh out what Regulation A+ actually is, sure, how it works, and what it's good for. So I do want to cover that at some point because I think it's important. Because at the end of the day, what it allows is it allows companies to go public on a more streamlined basis, a more simplified registration process, and then once they become public, there are lighter ongoing reporting requirements. For example, if you're a public company, you've got to file 10Ks and 10Qs every 3 quarters. The SEC in their proposed rules has lightened that up. It's lighter disclosure on the annual report. Instead of doing 3 reports, you only get to do 1, which in the mid-year, which is if you're a CFO, that's a good thing. So it also brings down the expense of being an ongoing reporting public company. So these are very important factors. And the truth is, when you look at the IPO market today, you've got big IPOs like Alibaba and LinkedIn and Facebook, but the days of the smaller IPO, which was back in the 80s and the 90s, of 25 to 35 million are gone. And so the hope and expectation of the industry really is this is going to rejuvenate IPOs for quote smaller amounts of money, which are not small, but those IPOs have basically gone away. So this is a very exciting development, and I think it's going to kick off what I call a whole new frontier in raising companies raising money that want to have liquid securities. And there's a good reason to want to have liquid securities. I mean, one basic reason, if I have lots of companies that come to me and they're trying to sell their securities privately, and they're private companies, and that's a lot more difficult than when you can say, I have a public company, and it has a value in the marketplace, and if you don't want to hold it indefinitely, which you have to do in a private placement for a private company, you can go sell your securities. So that's a really attractive benefit to being able to attract capital in the first place. The second thing from the company point of view is because your securities are liquid, when you're going and selling securities, you're going to, if you're in a private market, you're going to have what's called a valuation discount, meaning you can't sell these. There's no market to sell these securities. You're going to have at least a 1-year holding period, and so that's going to discount the amount that a company can get from those shares. And so not only is it bad for the company, but it's bad for their shareholders because it means that the company is forced to sell more shares at a lower price, and their shareholders get diluted. So liquidity is really a very, very important factor when you're comparing it to other methods of raising capital.
Sure, and that's an excellent point. And one clarification too that I want to ask you, because what a lot of people are waiting for is the opportunity for anyone, regardless of income, to invest in a startup company. Because right now the only option that is available through equity crowdfunding is for the wealthy investor, the individual who makes
Right.
200,000 or is worth $1 million in net worth. Now, the clarification that I have to ask you is, can the unaccredited investors under Regulation A, can they invest in both cases where the raise is below $5 million?
Yes, and I don't want
Raise
to confuse people, but the new Regulation A plus allows you to raise anything from $1 to $50 million, and under the proposed rules, and I expect the final rules will be pretty close to this. Unaccredited investors are allowed to participate. The only limitation is how much they can invest, which is going to be the greater of 10% of their income or net worth. I don't expect the final rules to deviate from that much, if at all. And the reason being, one of the reasons that Congress enacted this provision is to allow for democratization of investment. And not only did Congress get it, but the SEC is getting it. If you pay attention to speeches that the chair of the SEC has given publicly, she's very concerned about the ability of having markets that your average investor can get into. There are a lot of factors that play into that. One is companies are staying private much longer, and so because they're staying private much longer, then really the opportunity for your retail investors to get in and an investment is much further down the pike when they finally go public, when the upside return is not as great. And what people are also hearing from the financial experts, and I'm not one of them, is very simply that the way to build wealth is through investing, diversifying, number one, and investing in early stage companies as part of your portfolio, because while they have the highest risk, they also have the highest return. So if you're shutting out the average investor from these types of investments, that's not a healthy thing for investors.
Yes.
And I just make that point because I think what people like to talk about is how we need to protect investors from risk, especially unaccredited investors. And without getting into all that, there's another side to that coin, which people are starting to recognize now, both at Congress and at the Commission level, that it's important for wealth building and your retirement to be able to have diversification, invest in things that up until now have been restricted to accredited investors.
Absolutely, because ultimately, although the rules from the Great Depression were meant to protect the average everyday American from bad actors, from people who were just pumping and dumping stocks, ultimately they also kept them away from the best investments as well. And so, that also raises a different question. Well, we won't go in that today, but this new funding mechanism, Regulation A, it ultimately has a huge opportunity for educating people under investors, because my Twitter handle is Average Joe VC, because eventually through this crowdfunding model, all of the average Joes are going to be venture capitalists, because we're going to have to look at opportunities. We'll have to weigh the pros and cons. We'll have to assess if the business model will work. We'll have to read a financial statement to understand, are they making money, or what is their pro forma. So, there's a lot of interesting things happening, but you're right, diversification is going to be a critical element. And so I want to ask you as well, now that this looks like it's going to happen, and it doesn't look like things are going to deviate from the proposed rules. So let's assume that tomorrow they allow for unaccredited investors and accredited investors alike to start investing in companies, and with certain limitations on their income. How long will it take? Once they approve it tomorrow, how long will it take for us to see the first offerings legally be able to raise money through this new mechanism?
Okay, well, my expectation is the SEC will issue final rules tomorrow. And then the way things work is they become effective 60 days after the rules are published in the Federal Register, and that period of time varies anywhere from maybe 4 to 5 days to 15 days. So we will see final rules effective by the middle of June at the very latest, and I can tell you that there will be companies that are lining up and will file on the first day.
Wow. And by the way, tomorrow is Greek Independence Day, so there's 2 reasons to celebrate tomorrow. But that's amazing. So March 25th, and then so 2 months from then would be May 25th, and then ultimately we'll see some going through this.
Right, and then there's that period of time between the time they announce the rules, which is tomorrow, and when they actually publish it in the Federal Register, and that's somewhere between 5 and 15 days. So, so by early June, we'll see the folks at SEC Division of Corporation Finance get a lot busier reviewing these new registration statements.
So let me ask you this: from the entrepreneur's perspective, you know, because I know there's a lot of entrepreneurs with great ideas out there. To even be able to, you know, actually raise money in this way, naturally they're probably going to have to hire some very smart people like yourself. They'll need attorneys. They'll need other entities to help them prepare their offerings. How do you see this happening? Like, what is the cost going to be to the entrepreneur? And I know it's a guess at this point, but what are some of the costs that an entrepreneur will need to consider? And ultimately, will the entrepreneur need to market their offering, or will it work in a similar fashion like Title II is working, which is really blasting it to a database of accredited investors?
Right. Well, I mean, let me start with marketing the offering. As far as marketing the offering, a company can market it themselves. That's not, from my point of view, the preferred route, because most companies aren't really equipped to do that effectively, but some will do that. The better companies, the more attractive companies, are going to be marketed by broker-dealers. And the fact of the matter is, when you pay somebody commission, they're motivated to sell, and if you don't pay them a commission, they're not motivated to sell. That's just the reality of the business world, and that's the reality of Wall Street. And also, I think what you're going to see, too, is we have these entities out there. I refer to them as Title II platforms, and specifically what I mean is new Internet portals that have sprung up since the Jobs Act to go out and sell, to advertise and sell private placements to accredited investors, but are allowed to use general solicitation. I expect that we're going to see a number of those portals not stay in Title II with private placements, but they're going to move over into Reg A+. And the reason they're going to do that is because there's bigger dollars involved, and it's an opportunity for them to increase their exposure and subscriber base. So that's all good. There's some technical issues there. They're basically, to really play in that space effectively, they're going to have to be licensed as broker-dealers, but a lot of these newer Title II platforms are doing that and have done that, and if they haven't done that, they're in the process of doing that. So that's going to be a very, you know, we're not going to see, you know, even for, I say, a strong company that can do an underwritten offering, you're going to see different models developing that are working off of other parts of the Jobs Act. There's a clear interrelationship. Now, you know, the cost, I mean, basically your basic cost is, I mean, your biggest costs are going to be legal fees and accounting fees. You are required to have 2 years of audited financials. Companies that already have audited financials, and Manolis, you could speak to this better than I with your background. That's going to vary. It's going to depend upon the size of the company. You know, how big they are, whether the location, whether they're international or not, and also how many segments they have. So that's going to be a range. I'm reluctant to throw out numbers because it's a pretty big range, and for a company that's already, it depends on your auditor, and it depends on whether you already have audited financials and the complexity of your business. It could be, you know, a number as low as $25,000, and it can go up to $250,000 if you have a complex multinational business with a lot of divisions. And there will be companies like that, by the way, that will use Regulation A+. Legal fees, I think we're going to see a big range. It's going to be a much, much cheaper process than doing a full S1 registration for a number of reasons. One is competition. Number two, the cost is going to have to meet market expectations in the market. So, people throw out figures, to go public in an S1, 250 to 1,000, 500,000 for legal fees. Those numbers are going to be a lot lower than that. I think we're looking at well under 100,000 for your average company.
Wow.
So, I could just tell you numbers I've heard quoted outside, off the cuff. I've heard, one large firm say, well, it's going to be about the same as a regular registration. They're not going to do a lot of business. I've heard people quote, 40,000. Whatever it is, it's going to be substantially lower than an IPO. At the end of the day, it's a drop in the bucket compared to what you're going to raise. And here's an important point, too. The difficulty for businesses are looking at going public. They say, okay, this is how much it costs. A lot of those costs need to be spent up front before they know if they can sell it. One of the features that's always been a part of Regulation A+ is what's called testing the waters, which means that before a company ever files anything with the SEC and has to go out and pay money for lawyers and accountants, they can go out and solicit interest in the offering. And so that's at least a company, when they decide to commit for the funding, they have a pretty good idea what the level of interest is, and if it's not strong, then they abandon the offering. So that's a very critical point. I know it's come up in the Title III with crowdfunding, that's something that's not in there that needs to be in there, and I think it will be in there, because it's just a very practical consideration. I mean, companies are happy to spend $100,000 if they know they're going to get $10 million or $200,000. But you don't know that when you start out. So that helps temper this tremendously. So a company will have a pretty good reading on whether they can go out and sell their securities, and also at what price.
Interesting. No, I mean that's interesting. I didn't think of that testing the waters provision. That just popped a business opportunity in my head. Creating a testing the waters organization that doesn't actually do any of the funding, but helps people test the waters.
Well, and I have to tell you, a lot of these Title II platforms that aren't registered broker-dealers, or even if they are, they have a significant subscriber base. They have a lot of visibility out there, and those platforms will be used by potential Reg A+ issuers to test the waters. So, they're already equipped to do that. I mean, they're good at marketing. They're good at reaching out to their investor base. And they'll be able to do that, and the only legal requirement is that whatever materials you're using, you have to file with the SEC, but you don't need a lawyer to do that. So as far as that goes, so that's a simple process.
Excellent, Sam. And so, we have about 2 minutes left then for the people watching in Vicken in the virtual incubator. If you have any questions, you could start thinking about them and typing them in the chat room now. We'll switch over to the actual chat room and see if there's any questions at present. But Sam, actually, when you started saying how expensive, and I know comparatively to what they're going to raise, it's not expensive. But I'm always for the small business owners. I'm not talking about tech. I'm talking about the everyday small business, the mainstream American business. Is Reg A probably not for the everyday American business because of those initial costs, or can you see like very small offerings, let's say for $100,000 instead of $5 million, where the cost would be significantly less? It still wouldn't cost $25,000 if you're only trying to raise $100,000. What do you think of that?
Right. Well, I mean, there's different ways of raising capital, and each one has a different cost, and they all have pluses and minuses. And they're not all appropriate for the same situation. If you're a startup and you're not able to get the attention of VCs or the folks in Silicon Valley, which is most people, then Title III crowdfunding, when it goes live, and it will go live within the next 12 months, is a very attractive option. When you can get to a point where you can go out and get accredited investors interested, then a private placement or going on one of these platforms like AngelList or the like is a very good option. But when you get to a point in your business where you say, look, I'm past the business plan, I'm past proof of concept, I'm ready to go in production, or maybe I've set up one plant or one location, and now I need 20 or 50 million or even 10 million. That's when you want to start talking about how do I raise bigger amounts of money. That's when Regulation A+ comes into play. And let's say, for example, I have the kind of company that just doesn't appeal to VCs, which is most companies, okay? And it may be difficult to raise money through a private placement. So then having those liquid, freely tradable securities and being able to sell also to unaccredited investors makes it easier to raise that capital. Especially for certain types of companies will be very attractive candidates for Reg A+. The same kinds of companies that might be attractive as crowdfunded companies. There's a whole different range of companies that might be very attractive for Reg A+ offering, where they can attract popular support from your everyday person, but they're not of interest to the VC because they're not going to get a 1,000-time return on it, or maybe they have to invest a lot of money in inventory, and they say, no, we don't do consumer products. So it's for a company at a certain stage in its development.
So sorry to interrupt. Just one clarifying question, because this is kind of the point. Like, what if a business did not want to go after any accredited investors and only wanted to sell under Regulation A to unaccredited? Like if you wanted to do a $100,000 raise under Regulation A+, can you sell only to unaccredited investors if you wanted to?
Well, first of all, I mean, from a practical point of view, you're not going to want to use Regulation A+ for $100,000. I mean, it wouldn't. To me, it would make a lot of sense if somebody wants to do that and they want to go out to the crowd. Let's wait for Congressman McHenry to do his thing and get a real crowdfunding bill through Congress in the next few months, and that will happen. And then we'll have something useful, and that would be the way to go for that kind of offering. It wouldn't make any sense if you want to raise $100,000 to go file and to go public. So, I mean, and as a practical matter, I can't tell you what the floor is before it makes sense. Maybe it's 10 million, maybe it's 5 million. But once you go down to lower numbers, the cost benefit just doesn't make a lot of sense. There are other ways and better ways to raise money.
Okay, no, fair enough. I was trying to kind of get to that point because
Sure.
I think a lot of people are waiting for that, because an angel or venture capitalist is has a very specific criteria, and they may not see the efficacy of a deal until a certain stage. But it doesn't mean that an idea isn't going to make it because an angel or VC said no. That's the allure of the unaccredited investor side. So that's why I was just trying to get my audience to understand, is this possible now?
Sure.
But what you're saying is, once the actual Title III comes out, that'll be really what's going to benefit the small businesses who are trying to raise below $1 million.
Well, and I'm gonna slap you for saying below $1 million, because that is a number in Title III, but that's not going to be the number that we see coming out of Congress this year. I can't tell you how higher it's going to be. It's going to be higher than $1 million. It could be as high as $5 million. That depends on what happens in the legislative process. But we look at what the states are doing. They're very comfortable with $2 million. So we're going to be looking at bigger numbers for Title III type crowdfunding.
Great. And so I'm also going to be respectful of your time, because I know you have to leave at 8:45 Eastern. But we do have a question. I'm just going to share my screen so that the audience can see. We have a question within the incubator chat room.
Okay.
We have a gentleman named Lucas Marquard, and he says, what is the biggest opportunity that Regulation A+ creates? Or better question, describe the ideal candidate business to use Regulation A+. So I guess for the first question, how can people who are not raising money benefit from Regulation A+? So like the funding portals, the service providers, how can everyone else benefit outside of the company raising funds through Regulation A? What opportunities does that create?
For other than the issuing companies themselves?
Yeah, other than the issuing companies themselves, like what opportunities are there for others in this movement?
Okay, well, I think that, one of the bigger opportunities is one that I've mentioned, which, people aren't seeing yet, but they will see, which is, portals like AngelList and Seed Invest and the like. They are going to be moving, I believe, very actively towards Reg A plus offerings. They're gonna certainly stay with where they are with the offerings to accredited investors. But I think that's going to be a big area. So that's kind of going to expand, give a little more gravitas to these platforms who right now maybe they'll raise, your average raise is $1.5 million to $2 million. It's going to put them in a different ballpark. It's also going to make them, I think, more profitable as a business model because they'll be able to get involved in bigger deals. It's also going to move things more in the direction of from a traditional IPO marketing with a traditional roadshow to moving more towards the internet. I mean, it's not necessarily going to replace a lot of traditional ways of marketing, but it's certainly going to supplement it. So I think that's a big area. I think it's also very big for the broker-dealer community, especially the smaller firms, because smaller IPOs have just dried up since the 1990s, and I can tell you there's a lot of excitement, enthusiasm with smaller broker-dealers to get involved in marketing these deals. So I see that as a very big area. It's probably those are the two areas that come to mind. But again, the least obvious right now is what I call the Title II portals. It's going to represent a tremendous opportunity for them.
Very interesting. Okay, so you see existing portals who are operating in the accredited investor market will make a somewhat smooth transition to Regulation A, which will also involve potentially new products because now they have a new way to raise capital. It could result in innovative new ways and products. And actually, what industry do you think will really benefit? What industry out of everything that's happening now do you believe Regulation A will really take off on?
As far as companies?
Like,
as far as companies that are raising money?
Like not necessarily companies, but I mean like, for instance, biomedical, real estate, industry.
Okay, right, industries. Right. Well, I think, one area that's very, very excited about Regulation A+, just judging by visitors to the SEC to participate in the rulemaking process, is biotech and pharmaceutical. And the reason for that is very simple, that at least up until the last year, doing IPOs in the biotech just didn't happen. They were just not, they weren't attractive candidates for a variety of reasons. And so there's a tremendous interest and will be, I believe, a tremendous demand, especially on the higher side of the dollar range, 50 million, which, by the way, I believe ultimately is going to go up. The SEC has the authority to raise it. But that's going to be one, in terms of the higher end, that's where we're going to see a lot of interest. Is in that area that are traditionally haven't been well served by the IPO market. Now, the last year there's been somewhat of a resurgence, but I still think that's going to be a very big area. I think also companies that have what I call strong affinity groups, big following, the kind of like the companies that would appeal even in a Title III crowdfunding setting. They may not have they may not be able to track the interest of VCs, but they will be able to track and excite the crowd, particularly unaccredited investors. The products area, maybe even technology. I think that's we can expect to see that. So in terms of types of industries, real estate, it's hard to say. I mean, there's some people who said, well, I don't really see this for real estate, but I can tell you there's also a lot of people who do. So I expect we're going to find that the real estate industry is going to play in some respects in Reg A plus offerings. So companies that are it's just another way to access capital, and you're a reporting company, but you're not a fully reporting company, so it's not quite as burdensome. as being a fully reporting company. So I think we could actually see some interest in real estate there as well. But I mean, the bottom line is it's most companies are not served by VCs. They're not served by private equity funds, and so that leaves a whole big area out there that are potential candidates if they have a good business model, and if they're at the right stage of their development. They're gonna. This is something that they need to look at.
Very interesting. I'm going to tuck that affinity group comment in the back of my sleeve here because that's a very interesting thing you said there, Sam.
Yeah. Yeah.
So very good, Sam. I'm going to just check one more time. Lucas says, thank you very much. He also says, in regards to real estate, do you think they'll permit SPACs? Not sure what SPAC is.
SPACs, yeah. I mean, I can't. That's a pretty technical question. That's one I couldn't answer off the top of my head. And even if I could, I'd probably have to tell you that that'll depend on what the final rules look like tomorrow. So I'd say that's just a little too technical.
Great. No problem. I totally understand. So. Sam, I know we're short on time, but I want to just give you the last word on really anything you'd like to share, but kind of give us your glimpse of the next 1 to 5 years, and then you can kind of sign off as well. Kind of give us your farewell after you give the prediction.
Sure. Well, first of all, I think that whatever somebody may think, just on a gut level about Regulation A+. They need to understand that we're in a whole new world of capital raising. There's more of a focus now, finally, I think, in Congress, and we're starting to see signs from the SEC to really open up new channels for small business capital formation. And the Jobs Act was a huge catalyst for that, and that I expect that to develop and accelerate over the next 5 years, especially since we don't have Harry Reid in the Senate blocking bills that the Republicans want to get through to really open up things. And we're going to start to see that this year. Another big thing is and I'm just going to make this point too, everyone has to understand that these various methods of capital raising are interrelated. For example, somebody may say, well, I don't have any interest in Reg A+, I'm looking to do startups. The bottom line is, for all these companies that are out there doing now these Title II deals and they have restricted securities, well, guess what's going to happen when they have a successful exit? They're going to want to reinvest, and a lot of that money is going to trickle down to startups, crowdfunding. So we need to understand that there is that relationship in a relationship, and that's across the board, whether we're talking about accredited investor private placements, crowdfunding to unaccredited investors, or Regulation A+. The other thing is people really need to pay attention to, because this is going to become enormous, and it's going to drive all these markets. Something called venture exchanges. I expect we're going to see legislation this year which is going to create venture exchanges that are geared towards smaller stage companies, which have different lighter regulatory burdens, different types of trading. You may see things like stocks trading once a day by auction. I mean, we're going to see a whole different genre of exchange, and the net impact of that is if that can be done right, and I believe it will be done right, that's going to attract even more companies and more capital at lower stages to get to that place. They don't need to get to the top of the ladder. They don't need to get to the New York Stock Exchange. They can do. They have a rung of the ladder that's within reach. So that's a hot topic to watch this year, and all I can tell people is keep sight of the big picture here. Don't just get focused on one thing, because they're all tied together and they're all going to impact each other.
Sam, very wise words today. Very grateful to have you on. This has been one of the, this is, for the viewers tonight and for whoever's going to see this, you essentially are on the inside of an amazing revolution that is happening in capital formation. The SEC is voting tomorrow. And Sam, thank you very much for coming on our show tonight.
Thank you for having me, and I look forward to being on again. Thank you.
Absolutely, and everyone who's watching in all over the world and in Vicken, thank you as always. Without you, we couldn't do the things that we do here. And so until next time, dream it, believe it, achieve it.